Good evening. I'm bringing you an urgent financial story tonight that has been quietly circulating among institutional investors and wealth managers, but has received almost no mainstream media coverage. JP Morgan, one of the world's largest and most influential financial institutions, has issued what analysts are calling a final warning about Trade War 2.0. But this isn't about tariffs or quarterly GDP numbers. This warning concerns something far more fundamental: the potential unraveling of the US dollar as the world's reserve currency, and a corresponding price explosion in silver that could reach $500 per ounce or higher. If this analysis proves correct, we're looking at one of the most dramatic wealth transfers in modern economic history. Tonight, we'll examine the evidence, analyze the data, and explain why this isn't speculation. It's mathematical inevitability. Let's begin. First, let's establish the facts. According to JP Morgan's latest quarterly economic outlook, Trade War 2.0 could disrupt up to $3.4 trillion in annual global trade flows. That's not a recession forecast. That's not a temporary slowdown. That represents roughly 15% of total world GDP being thrown into chaos. The bank's analysts describe this as a structural break, not a cyclical downturn. The difference is critical. Cyclical problems resolve themselves over time. Structural breaks are permanent shifts that require a complete system reorganization. What we're witnessing is the fracturing of the post-World War II global trading architecture. The United States has imposed tariffs ranging from 25% to 60% on major trading partners. China, the European Union, Mexico, Canada, and others have retaliated with their own measures. Supply chains built over decades are being dismantled in months. But here's what's more significant than the tariffs themselves. Countries are no longer waiting for this to resolve. They're building permanent alternatives to dollar-based trade. Russia and India are settling energy transactions in rupees backed by gold reserves. China and Saudi Arabia are negotiating yuan-denominated oil contracts with gold convertibility provisions. The BRICS economic bloc, representing Brazil, Russia, India, China, and South Africa, is constructing an entirely parallel payment and settlement system designed to function independently of US dollars. These aren't contingency plans. These are operational systems processing billions of dollars in trade right now. According to data from the Bank for International Settlements, non-dollar trade settlement has increased 340% since 2020. That acceleration is unprecedented in modern monetary history. This is the $3.4 trillion disruption JP Morgan is warning about. And according to their internal analysis provided to wealth management clients, there is no realistic path back to the pre-2024 global trade structure. To understand why this matters, we need to examine what reserve currency status means for the United States and what happens when that status erodes. Since the Bretton Woods Agreement in 1944, the US dollar has functioned as the world's primary reserve currency. This means that international trade, particularly in critical commodities like crude oil, wheat, copper, and manufactured goods, has been denominated and settled in dollars. This created enormous structural demand for U.S. currency. If you're a country that wants to buy oil from Saudi Arabia, you need dollars first. If you want to import electronics from Taiwan, you need dollars. This mechanism forced every trading nation to hold substantial dollar reserves. The result? What economists call exorbitant privilege. The United States could print money and run massive budget deficits while other nations absorbed much of the resulting inflation. America could borrow at artificially low interest rates because global dollar demand remained constant regardless of fiscal discipline. But that system depends entirely on one thing: trust. Nations must trust that the dollar will maintain its value. They must trust that their reserves are safe. They must trust the system itself. And by every available metric, that trust is evaporating. Let me show you the data. Central bank dollar reserves have declined from 73% of total global reserves in 2001 to just 59% today. That's a 14 percentage point decline, representing trillions of dollars in real terms. This didn't happen overnight. It's a steady, relentless erosion that has accelerated dramatically since 2020. Meanwhile, central banks purchased 1,037 metric tons of gold in 2023 alone. That's the second highest annual total on record. Central banks don't buy gold for investment returns. They buy it as insurance against currency instability and system failure. China's central bank has added to its gold reserves for 18 consecutive months. Russia has been accumulating gold since 2014. India, Turkey, Poland, Singapore, major central banks across the developing and developed world are converting dollar reserves into physical gold at an accelerating pace. Why? Because the United States has weaponized the dollar. When Washington froze $300 billion in Russian foreign exchange reserves following the Ukraine invasion in 2022, it sent a message to every central bank governor on earth: your reserves are only safe if we approve of your government's policies. That was a turning point. It fundamentally altered how sovereign nations view dollar holdings. Reserves that were once considered risk-free assets are now understood to be conditional, subject to political judgment from Washington. The implications are profound. If you're the central bank of a mid-sized nation and you've watched the US freeze hundreds of billions in reserves from Russia, Iran, Venezuela, Afghanistan, and others, you have to ask yourself, could we be next? What policy disagreement might trigger our reserves being frozen? That question is driving de-dollarization faster than any economic factor could. This brings us to silver, and why this particular metal is positioned at the center of what could be the most dramatic commodity repricing event in decades. When international trade systems break down and nations lose confidence in fiat currencies, history shows they don't invent new paper systems. They revert to hard assets, specifically the monetary metals that have facilitated trade for thousands of years, gold and silver. But silver has unique characteristics that make it especially critical in this particular crisis. First, silver is affordable enough for practical trade settlement. Gold currently trades around $2,600 per ounce. That makes it ideal for large transactions and reserve storage, but impractical for medium-sized commercial deals. Silver at $30 per ounce provides the perfect denomination, valuable enough to be worth securing and transporting, but accessible enough for everyday commercial use. Second, and this is critical, silver has massive industrial demand that gold doesn't. Silver possesses the highest electrical conductivity, thermal conductivity, and light reflectivity of any element. This makes it irreplaceable in modern technology. Consider the scope of industrial silver demand. Solar panel manufacturing consumes approximately 100 million ounces annually and is growing exponentially as nations pursue renewable energy mandates. Electronics production requires silver for conductivity. Every smartphone, laptop, television, and computer uses silver components. Electric vehicle manufacturing uses 25 to 50 grams of silver per vehicle compared to 15 to 28 grams in conventional cars. As EV adoption accelerates, silver demand accelerates with it. Military applications including advanced weapon systems, radar, communications equipment, and missile guidance systems all require silver. Medical devices and antibacterial applications rely on silver's unique antimicrobial properties. 5G infrastructure build-out requires massive amounts of silver for the expanded network of transmission equipment. According to the Silver Institute's most recent supply-demand analysis, we're already running a structural deficit of 150 to 200 million ounces per year. Global mining production cannot keep pace with industrial demand alone, before considering any monetary demand whatsoever. Now imagine adding monetary demand on top of this already tight market. Let me give you a concrete example of what this looks like in practice. India needs to purchase 100 million barrels of crude oil from Saudi Arabia, a $7 billion transaction at current prices. Saudi Arabia doesn't want to accumulate Indian rupees because of liquidity concerns and capital controls. India doesn't want to hold Saudi riyals for similar reasons. Both nations are acutely aware of sanctions risk after observing what happened to other countries. The solution? Settle the trade in physical silver. At $30 per ounce, that single $7 billion oil transaction would require 233 million ounces of silver for settlement. That's more than the entire annual mining production of Mexico, the world's largest silver producer. Now scale that example. Multiply it by hundreds or thousands of bilateral trade deals occurring simultaneously as the dollar-based system fragments. You create a sudden, enormous surge in monetary demand for silver that the global market cannot possibly satisfy at current prices. The price must rise, not to some theoretical fair value, but to whatever level rations the available supply and makes non-critical transactions economically impossible. Before we discuss specific price projections, you need to understand a critical fact about how silver is currently priced, and why that pricing mechanism is on the verge of failure. The silver price quoted on financial networks, currently around $30 per ounce, is not determined by supply and demand for physical metal. It's determined by paper contracts traded on the COMEX Futures Exchange in New York. The problem? The paper market has almost no connection to physical reality. Industry analysts estimate that for every ounce of physical silver available for delivery, there are between 100 and 250 paper claims on that same ounce. Some estimates suggest ratios as high as 500 to 1. Think about what that means. Imagine a concert venue that sells 100 tickets for every available seat. This works fine, until everyone shows up simultaneously and demands entry. Then you have a crisis. That's the current silver market structure. The COMEX maintains roughly 300 million ounces of silver in registered vaults available for delivery. Yet open interest in COMEX silver futures typically represents claims on 900 million to 1.2 billion ounces. That's a 3-to-1 or 4-to-1 ratio just in visible paper contracts. When you include bank precious metal accounts, unallocated positions, ETFs that don't hold full physical backing, and over-the-counter derivatives, you reach those extraordinary 100 to 1 or 250 to 1 leverage ratios. This makes the 2008 subprime mortgage crisis look prudent by comparison. It's worth noting that JP Morgan itself paid $920 million in fines in 2020 for manipulating precious metals markets over an 8-year period. Federal prosecutors documented that the bank engaged in systematic price suppression through spoofing, placing fake orders to manipulate prices downward. But here's what's remarkable. While paying those fines, JP Morgan was simultaneously accumulating one of the largest physical silver positions ever assembled by a single institution. Independent analysts estimate the bank holds between 600 million and 1 billion ounces in physical form. Why would a bank pay nearly $1 billion in fines for suppressing silver prices while accumulating massive physical positions? The answer should be obvious. They're positioning for the physical price explosion they know is inevitable. The paper market functions as long as most contracts settle in cash and few participants demand physical delivery. But the moment countries begin demanding physical silver to settle international trade, the entire structure collapses. There simply isn't enough physical silver to honor all those paper claims. Not even close. Now let's examine whether $500 silver is realistic or hyperbolic. We'll use only verified data and conservative assumptions. The entire above-ground silver investment supply, including bars, coins, and institutional holdings, totals approximately 2 to 2.5 billion ounces, according to metals consulting firms and the Silver Institute. At current prices of $30 per ounce, that represents a total market value of $60 to $75 billion. For perspective, that's smaller than the market capitalization of Home Depot. The entire global investment silver market is smaller than a single retail chain. Annual global trade in goods and services totals approximately $25 trillion according to World Bank data. Now let's construct a scenario. Suppose just 1% of global trade shifts to physical silver settlement as dollar-based trade contracts. Not 10%, not 5%, just 1%. 1% of $25 trillion equals $250 billion in annual trade requiring silver settlement. At $30 per ounce, settling $250 billion in trade requires 8.3 billion ounces of silver per year. Total available investment supply is only 2 to 2.5 billion ounces. Annual new mining production adds roughly 800 million ounces, with approximately 80% already committed to industrial applications. Even with just 1% of trade shifting to silver, annual demand exceeds total available supply by a factor of 3 to 4. The price doesn't rise to fair value in this scenario. It rises to whatever level rations the scarce supply, whatever price makes silver expensive enough that only critical transactions occur. Let's calculate the required price mathematically. If we have 2 billion ounces available for trade settlement and we need to facilitate $250 billion in annual trade, what price per ounce does equilibrium require? $250 billion divided by 2 billion ounces equals $125 per ounce minimum. That's just for 1% of trade. What happens at 2%? At 5%? If 5% of global trade shifts to silver settlement, entirely plausible in a severe de-dollarization scenario, you're looking at $1.25 trillion in annual silver demand. With only 2 billion ounces available, simple arithmetic yields $625 per ounce. Suddenly, $500 silver doesn't appear speculative. It appears conservative. Historical precedent supports this analysis. In 1980, silver rose from $6 to $50 per ounce in months, an 8-fold increase. That was driven primarily by speculative demand from the Hunt brothers attempting to corner the market. In 2011, silver climbed from $11 to $49 in 18 months, a 4.5-fold increase. That occurred without any actual breakdown in dollar-based trade, merely concerns about sovereign debt. Now we're discussing actual structural change in the global monetary system, not speculation but nation-states with no alternative but to find dollar replacements. Under those circumstances, is a 15-fold to 20-fold price increase unreasonable? The mathematics and historical precedent both suggest it's not only reasonable, it may be inevitable. The implications extend far beyond investment portfolios. What JP Morgan is warning about, though not publicly, is the death of dollar pricing for commodities. For 80 years, everything from oil to wheat to copper has been priced in dollars. That created a system where dollar liquidity was essential for global commerce. When commodities begin trading directly for gold and silver, dollar prices become derivatives, secondary calculations rather than primary reference points. A barrel of oil might cost 0.5 ounces of silver. A ton of wheat might trade for 2 ounces of gold. The dollar price becomes whatever the dollar happens to be worth in metals at that moment. Not a stable benchmark, but a floating conversion rate. This represents a complete restructuring of the global monetary architecture. Reserve currency transitions don't happen overnight, but they do happen. The British pound maintained reserve status for nearly a century before the dollar replaced it. That transition took approximately 30 years, from 1914 to 1944, punctuated by 2 world wars and the Great Depression. We may be in the early stages of a similar transition now. Not through military conflict, but through economic fragmentation, weaponization of currency, loss of trust, and gradual construction of alternative systems. The question facing everyone, from policymakers to ordinary citizens, is straightforward. How do you preserve wealth during a monetary transition? Throughout history, the answer has been consistent. Hard assets, particularly precious metals, maintain purchasing power across monetary regime changes. Those who positioned early in previous transitions preserved and often multiplied their wealth. Those who didn't faced devastating losses as paper currency holdings evaporated. In fairness, let's examine scenarios where this thesis could be wrong. Central banks could successfully restore confidence in fiat currencies through coordinated policy and fiscal discipline. The dollar has survived predictions of its demise before. Central bank digital currencies could provide technological solutions to trust problems, creating new settlement layers nations find acceptable. Technology could discover substitutes for silver in industrial applications, reducing demand pressure. The trade war could de-escalate quickly, with commerce returning to dollar-based norms. Major new silver discoveries could rapidly increase supply. Each scenario is theoretically possible, but each faces significant obstacles. Restoring trust requires consistency and restraint, qualities absent in major economies running trillion-dollar deficits with no fiscal plan. CBDCs face adoption challenges and the same trust issues plaguing current systems. If nations don't trust the US not to freeze dollar reserves, why trust a digital dollar offering more control and surveillance? Silver substitution has been predicted for 30 years without success. Silver's properties make it nearly irreplaceable in critical applications. Trade war de-escalation seems unlikely, given domestic political incentives pushing toward further conflict. Mining development takes 7 to 10 years minimum from discovery to production, too slow for sudden demand spikes. Even if we're wrong about magnitude, silver at $30 offers asymmetric risk-reward. Downside appears limited to 22-25 based on historical support, roughly 20% potential loss. Upside in moderate scenarios suggests 75-150, 150% to 400% gains. In the full thesis, 500 plus represents 1/1500% returns. That's 1 to 10 or better risk reward. Such opportunities are rare in financial markets. Let me be clear about what this analysis indicates and what it doesn't. This is not a prediction of imminent dollar collapse or silver hitting $500 next month. These are complex multi-year processes that unfold gradually, then suddenly. What the evidence does suggest is we're witnessing structural change in the global monetary system, something that happens perhaps once or twice per century. The dollar's reserve status, assumed for 3 generations, is being actively challenged through policy mistakes, weaponization, and natural evolution of global economic power. JP Morgan's warning to their wealthiest clients reflects this reality. They're not making public statements that would trigger panic, but the message to private wealth clients is clear. Physical precious metals represent essential insurance against monetary instability. The confluence of factors we've examined, trade disruptions, de-dollarization, paper market leverage, industrial deficits, and emerging monetary demand, creates what analysts call a perfect storm for silver. Whether that storm produces $500 silver or $300 silver or merely $150 silver is unknowable. What is knowable? Current prices around $30 appear dramatically disconnected from supply-demand fundamentals that will govern physical markets when paper systems break. Those who study monetary history understand a fundamental truth. Paper currency experiments always end. Every single one throughout recorded history has eventually failed. The current global experiment with pure fiat currencies, backed only by government promises, is barely 50 years old, dating to 1971. By historical standards, this is very young, and it's showing severe stress. Gold and silver have been money for 5,000 years, not from tradition, but because they possess qualities uniquely suited for that purpose: scarcity, durability, divisibility, and universal recognition. When trust in paper fails, humanity returns to what works. JP Morgan understands this. Central banks quietly accumulating gold understand this. Sovereign wealth funds repositioning understand this. The question is whether we understand it in time to act, or dismiss these warnings until it's too late. That's our report for tonight. Thank you for watching.